Okay, so you want to own a parking lot. Paved land in a high-traffic urban area. Cars pulling in hourly, daily, monthly. No employees, no inventory, no buildings to maintain. Just pavement, a payment system, maybe a gate arm. Drivers pay $10, $20, $50 per day to park. You collect the money, the lot sits there, and land appreciates underneath. Sounds like the perfect passive real estate income business. And honestly, from the outside, it really does look that way. But here is what people who actually own profitable parking operations know, and what most people looking at parking lot investments never tell you. A parking lot is not a piece of pavement that prints money while you sleep. It is a low-margin, high-fixed-cost real estate holding play where your revenue depends entirely on consistent demand from businesses, events, or commuters you do not control. Where property taxes in urban areas can consume 30% to 50% of gross revenue before a single car parks, where you are competing against street parking, ride-sharing, remote work, and municipal garages that operate at a loss using taxpayer subsidies, where technology costs to accept credit cards and prevent theft eat another 8% to 15% of revenue, and where your highest and best use is often not operating a parking lot at all but selling to a developer who will bulldoze it and build apartments, making your passive income stream a constantly depreciating asset waiting for obsolescence. The cash flow can be real. The hidden costs are real, in ways that most people never see coming. Let's start at the beginning. When people say parking lot, they could be picturing three fundamentally different assets. A surface parking lot, a paved piece of land at grade level with striping, perhaps a payment kiosk or attendant booth, serving 30 to 150 cars depending on size. This is the lowest capital intensity option but also generates the lowest revenue per square foot of land. A parking structure or garage, a multi-level building, either above ground or below ground, serving 200 to 800 plus cars depending on floors and footprint. This is capital intensive, $25,000 to $50,000 plus per parking space to build, but generates dramatically higher revenue per square foot of land. Or a hybrid surface lot with valet stacking, where attendants park cars in tight formations, sometimes double stacking, increasing capacity by 40% to 80% compared to self-park. This requires labor but maximizes revenue from limited land. Each model has radically different economics, capital requirements, and risk profiles. Here is something that surprises people when they first look at this industry. The United States has an estimated 500 million to 2 billion parking spaces, depending on how you count street parking, driveways, and private lots. That is roughly 2 to 8 parking spaces per car. The commercial parking industry, paid parking lots and garages, generates approximately $25 to $30 billion in annual revenue. But the market has been under structural pressure for a decade. Ride-sharing services like Uber and Lyft reduced parking demand by 5% to 15% in major cities between 2014 and 2019. Then COVID-19 devastated demand as office workers stayed home. Entertainment venues closed, and urban foot traffic collapsed. As of 2024, parking demand in major urban centers has recovered to only 70% to 85% of pre-COVID levels in most markets. Remote and hybrid work is permanent. Fewer people commute 5 days per week. Transit ridership is down. Downtown retail has struggled. And cities are actively hostile to surface parking lots. Urban planners view surface lots as blight, wasted land that should be housing, retail, or parks. Cities impose minimum parking requirements on new developments but discourage standalone lots through zoning, taxation, and regulation. The parking lot is an interim use, a placeholder waiting for something more valuable to be built. You are not investing in a permanent income-producing asset. You are buying a holding pattern with a shelf life. Before you spend a single dollar, you need to understand the two paths into this business. Buying land and operating a surface lot yourself, or buying an existing parking operation with established cash flow. Let's start with buying land and developing a surface lot. You find a 20,000 square foot parcel, roughly half an acre, in a secondary urban location, 3 blocks from a business district, near offices, restaurants, and a hospital. Zoning allows commercial parking. Land costs vary enormously by location. In a tertiary market or exurban area, $5 to $15 per square foot, $100,000 to $300,000 for 20,000 square feet. In a secondary urban market, $25 to $80 per square foot, $500,000 to $1.6 million. In a primary urban core like downtown Seattle, Boston, or San Francisco, $150 to $500 plus per square foot, $3 million to $10 million. Let's model a secondary market. You buy 20,000 square feet at $40 per square foot, $800,000. Now you need to develop it for parking use. Site preparation and grading. The land might have an old building that needs demolition, $15,000 to $80,000 depending on size and hazardous materials. Grading and excavation to create level parking surface, $8,000 to $25,000. Paving. Asphalt paving for a parking lot, 20,000 square feet at $3 to $6 per square foot installed, $60,000 to $120,000. Concrete is more durable but costs $8 to $14 per square foot, $160,000 to $280,000. Striping and signage. Painted parking stall lines, directional arrows, ADA-compliant accessible spaces, signage. $3,000 to $8,000. Lighting. Parking lots require lighting for safety and security. Pole-mounted LED lights, 8 to 15 poles depending on layout, $2,500 to $6,000 per pole installed. Total $20,000 to $90,000. Drainage and stormwater management. Cities require parking lots to manage runoff. Catch basins, underground detention, permeable paving sections. $15,000 to $60,000 depending on site conditions and local regulations. Fencing and landscaping. Perimeter fencing if required, $8,000 to $25,000. Landscape buffer strips to meet zoning codes, $5,000 to $15,000. Payment and access control systems. If you are running pay-per-use, you need pay stations or kiosks accepting credit cards, cash, and mobile payments. Pay-on-foot kiosks, $8,000 to $18,000 per unit. You need 1 to 2 for a 70-space lot. If you are running gated access with ticket dispensers and exit gates, ticket spitters, gate arms, and payment integration, $25,000 to $60,000 for entry and exit lanes. Or you go app-based with signage directing users to pay via Park Mobile, Spot Hero, or a custom app. Lower upfront cost, $2,000 to $8,000, but higher ongoing transaction fees. Security cameras. 4 to 8 cameras covering entry, exit, and lot areas, $4,000 to $12,000. Permits and engineering. Civil engineering, site plans, stormwater plans, $8,000 to $20,000. Permits and approvals, $3,000 to $12,000. Total development cost for a 20,000 square foot surface lot, 60 to 75 parking spaces depending on layout efficiency, $150,000 to $450,000. Total investment, $800,000 land plus $280,000 development equals $1,080,000. You finance this with 30% down, $324,000, and borrow $756,000 at 7% over 20 years. Annual debt service, approximately $70,500. Now let's talk about revenue. How does a parking lot actually make money? Revenue depends entirely on location, demand drivers, and pricing strategy. Demand drivers. Why do people park in your lot? Office workers commuting Monday through Friday. Hospital visitors and staff. Restaurant and retail customers. Residents of nearby apartments without parking. Event attendees, concerts, sports, conferences. The best parking lots have multiple overlapping demand drivers. Weekday office demand, evening restaurant demand, weekend event demand. Single-purpose lots, only serving office workers, sit empty nights and weekends. Pricing models. Hourly parking, $2 to $8 per hour depending on market. Daily maximum, $10 to $40. Monthly permits for commuters or residents, $80 to $350 per month depending on city and scarcity. Event parking, $15 to $60 per event depending on proximity to venue and event type. Let's model a 70-space surface lot in a secondary urban location serving office workers and some evening/weekend demand. Monthly permits. You sell 50 monthly permits at $120 per month. These are commuters who park weekdays. Monthly permit revenue, $6,000 per month, $72,000 annually. Transient daily parking. The remaining 20 spaces, plus turnover from permit holders who do not show up, you sell as daily parking. On weekdays, you average 25 transient parkers at $12 per day. Weekends, you average 15 parkers at $10 per day. Weekday transient, 25 cars x $12 x 22 weekdays per month, $6,600 per month. Weekend transient, 15 cars x $10 x 8 weekend days per month, $1,200 per month. Total transient, $7,800 per month, $93,600 annually. Total gross revenue, $72,000 plus $93,600 equals $165,600 annually. That is a 15.3% gross yield on your $1,080,000 investment. Not bad for passive real estate. But now let's talk about the costs everyone forgets. Property taxes. This is the silent killer of parking lot economics. Land is assessed at market value. Your 20,000 square feet in a secondary urban area might be assessed at $35 to $50 per square foot, $700,000 to $1 million, even though you paid $800,000. Effective property tax rates in urban areas, combining city, county, school district, and special assessments, run 1.5% to 3.5% of assessed value depending on state and city. At $850,000 assessed value and 2.2% effective rate, your annual property tax is $18,700. That is 11.3% of your gross revenue gone before you collect a dollar. In high-tax cities like Chicago, Newark, or Detroit, effective rates can hit 3% to 4%. Your annual tax bill would be $25,500 to $34,000, consuming 15% to 21% of gross revenue. Payment processing and technology fees. If you accept credit cards, you pay 2.5% to 3.5% per transaction. If 70% of revenue is card-based, that is $4,040 to $5,656 annually. If you use a third-party parking app like Spot Hero or ParkWiz, they take 10% to 30% of transactions they facilitate. If they drive 30% of your transient volume, $28,080, and take 20%, that is $5,616. Total payment and technology fees, $8,000 to $12,000 annually, 5% to 7% of revenue. Maintenance and repairs. Asphalt degrades. Potholes develop. Striping fades and needs repainting every 2 to 3 years, $2,500 to $5,000. Snow removal in winter climates, $800 to $3,500 per season depending on snowfall. Lighting repairs, $500 to $2,000 annually. Gate arms and pay stations break, $1,500 to $4,000 annually in service and repairs. Asphalt resurfacing or seal coating every 5 to 7 years, $15,000 to $35,000. Amortized annually, $2,500 to $6,000. Total maintenance, $6,000 to $15,000 annually. Management and labor. If you self-manage, monitor cameras remotely, handle customer service emails, and process monthly permit applications yourself, labor is your time, maybe 3 to 6 hours per week. If you hire a parking management company, they take 20% to 40% of gross revenue. At 30%, that is $49,680 annually. That is the difference between profit and loss for most lots. Most small operators self-manage or use a hybrid model, hiring a part-time attendant for peak hours or events, $8,000 to $20,000 annually. Insurance. General liability property insurance. Annual premiums, $3,000 to $7,000 depending on location and coverage. Utilities. Electricity for lighting, $150 to $500 per month. $1,800 to $6,000 annually. Trash and cleaning, $100 to $300 per month. $1,200 to $3,600 annually. Permits and licenses, annual business license, parking operator permits, $500 to $2,000. Let's add it up at $165,600 annual gross revenue. Self-managed. Property taxes, $18,700 payment processing and tech fees, $10,000 maintenance and repairs, $9,000 labor, part-time attendant, $12,000 insurance, $5,000 utilities, $3,500 trash and cleaning, $2,000 permits, $1,200 total operating expenses, $61,400. Net operating income before debt service, $104,200. Subtract annual debt service of $70,500. Net cash flow, $33,700. On your $324,000 down payment, that is a 10.4% cash-on-cash return in year one. That is respectable. But you are working 3 to 6 hours per week managing it, 156 to 312 hours annually. At $33,700, you are earning $108 to $216 per hour for your time, which is excellent. Plus, you are paying down principal and benefiting from land appreciation. Over 10 years, you pay down $150,000 in principal. If the land appreciates 3% annually, it is worth $1.075 million. Your equity grows from $324,000 to $625,000. Plus, you collected $337,000 in cumulative cash flow. Total 10-year return, $638,000 on $324,000 invested, 11.5% annualized. That works if everything goes according to plan. But here is what destroys parking lot economics. Demand evaporation. Your parking lot serves a 300-person office building 2 blocks away. 60 of your monthly permit holders work there. The building's largest tenant, a law firm with 120 employees, announces they are going fully remote and terminating their lease. Overnight, you lose 25 monthly permits, $3,000 per month, $36,000 annually. Your NOI drops from $104,200 to $68,200. After debt service, you are netting $0 and working for free. Or a new 8-story parking garage opens 1 block closer to the office core. It charges $110 per month, $10 less than you. It is covered, safer, and more convenient. You lose 30 monthly permits. Revenue drops $43,200. You are now losing money. Development and highest and best use pressure. A developer approaches you. They want to buy your lot for $1.3 million. They are building a 6-story mixed-use building with ground floor retail, offices, and apartments. You are tempted. You would net $520,000 after paying off the loan. That is a 60% return on your initial $324,000 in 5 years. But if you sell, your income stream disappears. You have to redeploy $1.3 million into another investment. Finding another parking lot deal at similar yields is difficult because every parking lot faces the same pressure. Or worse, the city rezones your lot for residential use and imposes a vacancy tax on surface parking, $15 to $40 per parking space per month for lots that remain undeveloped. Your holding costs spike. You are forced to sell or develop. You are not a developer. You sell at a discount. The parking lot was never a permanent asset. It was a countdown clock to redevelopment. Regulatory rate caps and restrictions. Your city passes an ordinance capping parking rates. Daily maximum cannot exceed $15. Monthly permits cannot exceed $130. You were charging $160 monthly. You just lost $30 per permit per month. At 50 permits, that is $18,000 annually. Or the city mandates you install EV charging stations at 10% of spaces within 2 years. 7 EV chargers at $4,000 each installed, $28,000 in capital expenditure. Or the city requires you to repave with permeable pavement to meet new stormwater regulations. Cost $140,000. You do not have the capital. You take a loan, adding $18,000 annually in debt service. You are now losing money. Technology disruption and fraud. Customers figure out they can dispute credit card charges for parking, claiming they did not park or the signage was unclear. You face $1,500 to $4,000 annually in chargebacks and fraudulent disputes. Or your pay station gets vandalized repeatedly. Thieves pry it open looking for cash. You switch to cashless, which reduces vandalism but increases processing fees. Or a customer trips on a pothole in your lot, claims injury, and sues for $60,000. Your insurance covers it, but your premium increases 40% the following year, adding $2,400 annually. Property tax reassessment. The city reassesses your property. Assessed value increases from $850,000 to $1.15 million based on recent land sales in the area. Your annual property tax jumps from $18,700 to $25,300, an increase of $6,600. Your NOI just dropped from $104,200 to $97,600. After debt service, cash flow is $27,100, a 19.6% decline. Competition from free or subsidized parking. A new office building opens nearby with 200 parking spaces included free for tenants. You lose 12 monthly permits. Or the city builds a municipal garage and subsidizes rates at $80 per month, 33% below your rate. You lose 18 permits. Or ride-sharing becomes so cheap and convenient that commuters stop driving. They Uber to work for $8 each way, $16 daily, $320 monthly. Your monthly permit at $120 is cheaper, but they prefer the flexibility and do not want to own a car. You lose customers not to another lot but to a different transportation mode entirely. Economic downturn. A recession hits. Offices downsize. Retail closes. Restaurants reduce hours. Parking demand drops 20% to 35%. You cut rates to maintain occupancy. Monthly permits drop to $95. Daily rates drop to $9. Revenue falls from $165,600 to $118,000. Your fixed costs, property taxes, insurance, debt service do not decline. Your NOI collapses from $104,200 to $56,600. After debt service, you are losing $13,900 annually. You cover the shortfall from personal funds for 2 years, $27,800. By year 3, you cannot sustain it. You sell at a loss or let the bank foreclose. Let's talk about the operators who make parking lots work profitably long-term. They do not buy land. They lease it. They negotiate 10 to 20-year ground leases with landowners at $4,000 to $15,000 per month. They invest $150,000 to $350,000 in paving and equipment, not $1 million in land acquisition. Their capital efficiency is dramatically higher. If demand disappears, they walk away at lease end. They are not stuck with $1 million in illiquid land. They operate multiple lots to achieve scale efficiencies. A single lot needs dedicated management time. 10 lots in one city share one manager, centralized payment processing, volume discounts on maintenance, and group purchasing for technology. Operating expense ratios drop from 37% of revenue to 28% at scale. They focus on event parking and variable pricing. A surface lot near a stadium or arena sits empty most days but generates $3,000 to $12,000 per event, 25 to 60 events per year, $75,000 to $720,000 in high-margin event revenue. They use dynamic pricing software that raises rates during peak demand and lowers them during slow periods, maximizing revenue per space. They add ancillary revenue, car washes, detailing services, oil changes, EV charging fees. A parking lot generates $165,600. Add a self-service car wash generating $45,000 and EV charging generating $18,000. Total revenue is now $228,600 on the same footprint. They negotiate tax abatements or challenge assessments. In many cities, surface parking lots are overassessed relative to actual income-producing capacity. A successful assessment appeal can reduce property taxes by 15% to 30%, adding tens of thousands to NOI. They embrace automation. Fully automated lots with license plate recognition, no gates, no kiosks, app-only payment. Operating costs drop by 40% to 60% compared to staffed or semi-staffed operations. And they understand the exit. They buy lots in growth corridors where land values are appreciating 5% to 10% annually. They operate for cash flow, but their real return comes from selling to a developer in 7 to 12 years at 2x to 3x their purchase price. Let's run the numbers two ways. Best case scenario. You lease land in a dense urban area near a hospital and university. Ground lease, $8,500 per month, $102,000 annually. You invest $220,000 in paving, equipment, and technology. You operate 85 spaces. Monthly permits, 60 at $145, $8,700 per month, $104,400 annually. Transient parking, averaging $140 per day, $51,100 annually. Event parking, 40 events per year averaging $1,200, $48,000. Total revenue, $203,500. Operating expenses, ground lease, $102,000 property taxes. None, you lease. $0 payment processing, $11,500 maintenance. $8,500 labor, part-time, $14,000. Insurance, $4,500 utilities, $4,000 other, $3,000 total. $147,500 net operating income, $56,000. You have no debt. You invested $220,000 cash. You are generating 25.5% cash-on-cash return annually. By year 4, you have recovered your initial investment. Years 5 through 20, assuming lease renewal, you generate $56,000 plus annually in passive income. Realistic scenario. You bought land for $950,000 in a tertiary urban market. Development cost $310,000. Total investment $1.26 million. You financed 70%, $882,000 at 7.5% over 20 years. Annual debt service $84,000. Down payment $378,000. You operate 72 spaces serving a small office park and some retail. Monthly permits 35 at $95, $3,325 per month, $39,900 annually. Transient parking $68,000 annually. Total revenue $107,900. Operating expenses, property taxes, $22,000 payment processing, $6,500 maintenance, $7,500 labor, $10,000 insurance, $4,800 utilities, $3,200 other, $2,500 total, $56,500 NOI, $51,400. After debt service of $84,000, you are losing $32,600 annually. By year 3, cumulative losses are $97,800. You have invested $475,800 total. You try to sell. The market is soft. Buyers offer $1.0 million. After paying off $825,000 in remaining debt and closing costs, you net $145,000. You lost $233,800 over 3 years. The difference between those outcomes is land ownership versus lease, location quality, revenue density, and demand stability. The parking industry generates $25 to $30 billion annually in the U.S. There are parking operators running 50-plus lots generating $8 to $20 million in annual revenue and $2 to $5 million in EBITDA. But the median small parking lot, 50 to 100 spaces, generates $90,000 to $220,000 in annual revenue, and produces NOI of $30,000 to $90,000 before debt service. The people who succeed understand this is a land arbitrage and demand capture business disguised as passive real estate. They lease land, not buy it. They focus on locations with multiple overlapping demand sources. They operate at scale for efficiency. They automate ruthlessly. They plan their exit to a developer from day one. The people who fail believe parking lots are passive mailbox income. They overpay for land in declining areas. They underestimate property tax burden by 50%. They assume demand is permanent when it is fragile. They do not account for technology costs and fraud. They compete against subsidized municipal parking and lose. The cars park automatically once drivers pay. The gate arm lifts on its own. But the lot does not run itself.